Gold has significantly outperformed major equity indices such as the S&P 500, the MSCI World Index, and long-dated U.S. Treasuries since the start of 2024.
So should you buy gold? We spoke to our committee member and financial markets expert, Laurent Lequeu, to share his perspective on this precious metal. In this video, Laurent explains why gold is in demand by investors. Firstly, this surge is attributed to the metal's historical role as a hedge against economic uncertainty and government-related risks, benefiting from the ongoing conflict between Ukraine and Russia and the weaponization of USD assets. Secondly, the dilution of fiat currencies over the past decades, accelerated by economic crises and increased government spending, is also playing a crucial role in bolstering gold's appeal. As an example, current geopolitical tensions and economic weaponization have prompted China to significantly reduce its holdings of U.S. Treasury and agency bonds in the first quarter of 2024. This shift from dollar assets to physical gold has led China's gold reserves to climb to 4.9% in April 2024, the highest level recorded since data collection began in 2015. This transition is motivated by fears of potential defaults of Western government in the event of escalating conflicts, driven by policies from Washington and Brussels. For investors, the implications are clear. Gold's role as an anti-fragile asset is critical amidst rising government debt and inflation. In the current environment, the traditional 60-40 investment portfolio of stocks and bonds has become obsolete. Investors should consider shifting towards a combination of IT and energy stocks, with a significant allocation to physical gold as the anti-fragile asset. This portfolio can thrive amid ongoing economic weaponization and inflation, both of which erode the value of government bonds. In emerging markets or EM, demand for gold likely stems from cultural biases and a lack of trust in governments, local rule of law, or financial intermediaries, making gold a natural savings choice. This explains why gold prices rise when EMs thrive and fall. Essentially, in the past, gold has been a low-beta way to play EM growth. This trend is supported by the non-confiscable nature of gold and is illustrated by John Exter's inverted pyramid of risk, which shows that during crises, capital flows toward assets with no counterparty risk like gold. Currently, demand from emerging market central banks has been a key driver in the gold market, but private investors in developed markets have yet to jump on this bandwagon. Considering all this, gold may not seem expensive at all. Some investors may consider it cheap. Central banks and policymakers understand that there are two ways to square public accounts with trillions of dollars of unfunded liabilities. Either repay those obligations with a worthless currency or default under the pretext of war. In this context, staying in cash can be dangerous, accumulating government bonds can be reckless, and rejecting gold may be denying the reality of money. We hope you enjoyed this video. Subscribe to our YouTube channel for more videos to help you invest better. Visit our website www.intothemoneyverse.com for guides and tips to help you understand money better.